Good afternoon, everyone. This is Trader Tim from eMiniMind.com. Today is Monday, February 20th, 2017, and there just seems to be no stopping the market, continuing on higher. The last week we saw another couple of days of new highs and then moving sideways on Thursday and Friday inside bars. Today is a President's Day, market holiday, so not really counting this futures price action right now, but we'll see what we get on Tuesday in the markets. As we talked about last week, when we start getting into these situations where the trend line gets really steep, we have sort of a shallow trend line down here and then almost a straight up trend line. The market can't go up forever, so I would continue to trade these moves intraday, but I'm not necessarily looking to be adding to longer position longs up at highs. If we look at some of the broader market, the S&P and the Dow are pretty much same scenario and pretty decent volume on these last few days up. If we look at the NASDAQ, also looking very, very strong. And then the Russell not quite as strong, but still making new highs. Some of those individual stocks like Google, interestingly enough, not making new highs, whereas Apple, Netflix, these stocks are up at highs. Netflix is a very strong uptrend going. So as we head into next week, there's really not. So we're at the negative 61.8 of the large 50% retracement, the really big one at 2086s. We're also at the negative 61.8 from the most recent daily 2262.25s. We could draw from highs to highs if we start to see some sort of a pullback. And just noting the trend since the 8th of February, the market has not broken the previous day's low. So if you're in a daily trade, one of the things that we talk about intraday is, let's say you entered the daily 50% retracement on the S&P. Maybe you bought the SPY at the 50%, leaving your stop alone till the market breaks out of highs, and then every single day, once the market closes, you can put your stop underneath that daily low. And then the next day, we've gapped up, we've made a new high. As long as the market makes a new high, you can move your stop up underneath the candle's low. So currently, I don't tighten my stop underneath the inside day candles. So you would just leave it underneath the candle from the 15th. And then these inside days can kind of chop around a little bit. And then if we break out, you're still in the trade. So a break in the recent trend would be a break below the 2332 on the E-mini S&P. And so that would be the first sign that the trend is changing. And if we do start to roll over, then I would expect there to be a lot more profit taking and people kind of jumping out, and a move back down to one of these shallower trend lines would be more likely. Now you can draw from highs to highs and try and see if there's a reaction at an extension, but typically once the market has moved this far, an extension is such a it's a much lower risk entry point versus getting in all the way back at the traditional low to high 50% retracement. So this week, Tuesday, we've got PMI in terms of news. Wednesday, existing home sales. FOMC minutes will be coming out Wednesday afternoon. Thursday, jobless claims, and Friday, new home sales. So, still more news. It seems like no matter what comes out in the market news-wise, it's just taking it and making new highs. So we'll see what happens. If we back up here, one of the things you hear in the media is, how this is so incredible, this move higher. But if we come back to a let's see, what do they do? 10-year. Let's go further. We'll do a monthly. We'll go back as far as we can. 20-year monthly, and this move that we have here is, it's not that big. It's not that unprecedented. So far in the month, we've got about a 90-point range, and if we come back to the lows from 08, 09, I mean, some of these monthly bars that were just month after month of uptrend, bullish price action. So, when you're zoomed in on a daily chart, it can seem like we're going straight up, but when you zoom out, sometimes there's a lot more that can be sort of put into context based on there's the run from 2010 all the way up 2015, and then the pullback, and the run up from 2016 all the way up to where we are now. So just, it's always important to kind of go out to a bigger time frame every so often just to keep things in context. But that's what we're looking at going into this week. And you can find more over at eminimind.com. And I hope you have a great trading week. We'll talk to you soon.